I am more interested in learning than I am being right. So I love the contrast back and forth.
Thank you for fielding my questions. I come with scrutiny always, but I mean it with love.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to our latest episode of Physician Sense. I'm your co-host, Tyler Olson, and my co-host, Chad Chubb. So nice to see your sunny self. How you doing today, Chad?
Good to be back. Good to be back in the studio.
Yeah, same here. And we have a fantastic guest with us today. I think every doctor, either right now or like in recent history, has been wondering, should I buy a home now? When should I buy a home? Should I refinance my 7.5% interest mortgage? And so we're really glad to have Josh Mettle here. Josh is the owner of a mortgage bank, Neo Home Loans. And Josh, thanks for coming. We're looking forward to talking.
Hello, Chad. It's great to be with you and great to be with your audience today. Let's get into this and give some real value to all of your incredible listeners. I'm excited for this. Thanks for having me.
I was going to say, Josh, it's just really nice to have you too, because I feel like if we go back in time, like the first day I learned about physician mortgages, 13 years ago, get into the physician space, I feel like you were the first name that I saw out there and just being part of the white coat investor community. So it's really great to have you on here. I'm excited to dig into this. And Tyler, I think you nailed the intro there. Definitely a topic that one of those like hidden topics that everyone wants to ask about, but there's just not a ton out there on it. So I'm excited to get into it. I apologize for cutting you off. I know you were excited too, but want to throw that shout out there.
I appreciate you aging me, Chad, and telling everybody how long I've been in the physician lending space. There's a little extra gray hair coming through.
It means that I was also at that time. So it wasn't to throw anything of that nature out there, but I just remember from the start, you were always one of the best resources out there for learning about this. And, whenever you niche and you really get into the weeds, right? It's, you're not just average mortgage out there for physicians. You have this very unique option for the bulk of you, especially early on, and you start going down that rabbit hole. And I feel like I just kept coming back to content from you, updates from you. So it's great to have you on here and we'll get into it now. So I appreciate it.
Thank you. Glad to be here.
So Josh, frankly, I've got like a million questions, but I've got one that I really want to hear your thoughts on. What are like the top one or possibly two problems that you think experts like you can help physicians solve?
Great question. So let's look at it from a purchase dynamic and then maybe a refinance dynamic, Tyler. I think in the purchase market, we've heard that real estate is a local thing. So oftentimes you hear about national appreciation news, but that doesn't encompass the specificity of local neighborhood. So in other words, we may be in Florida, you may have a physician buying in Florida, and there's growing supply of inventory. And in that market, what I think physicians looking to buy a home should know is that they should be negotiating concessions from a seller, which can be used to either temporarily or permanently buy down the interest rate on their mortgage. Look, this elevated interest rate environment is not a 30-year problem, right? We need to solve for the next 1, 2 to 3 years. And at some point in that period of time, as mortgage interest rates always do, they're cyclical. You'll have a period where they rose, which mortgage rates follow the rate of inflation. Inflation peaked several years ago, and now we're starting to see inflation come down. And as we do, mortgage rates will follow. So how do we get through this temporary period of elevated interest rates? Well, we can use concessions from a seller. So typically when somebody goes in to negotiate on a home, let's just take Florida, for example, because the inventory levels in a lot of areas in Florida, maybe ex-Miami, are expanding. So that means sellers are getting a little bit desperate. So you can do two things in that scenario. You can negotiate the price, or you can negotiate cash called concessions from the seller. The little secret is that most people don't know is that concessions from the seller used to either temporarily or permanently buy down your mortgage interest rate has an impact on the payment 3 to 7 times as much as reducing the price. So in other words, if I get $20,000 price reduction, maybe I save $123 a month. I take that $20,000 and I do what's called a temporary mortgage rate buy down. You could save $1,100 a month. So you want to be working with a mortgage professional who knows your local market data and what's happening in terms of inventory and supply and demand. And then you want them to help you educate you how to leverage that elasticity in the market to reduce your payment as much as humanly possible. If that's your deal, but that's most people's issue right now is, hey, I'm relocating across the country. I want to buy a home. I love the area. I hate the mortgage rate. All right, let's figure out how do we solve for that in the near term.
I need more. How does I know you just picked those numbers out there, but how does those two steps change between $120 a month in savings versus $1,100? What can you walk me through that?
Yeah, if you take $20,000 and you run it through an amortization chart at, say, let's just throw out an interest rate of 7%. It's probably a little less than that right now, but just ballpark, right? You're going to get a payment around $120, $140 a month savings. So that's your monthly savings with negotiating the sales price down 20 grand. If I take that $20,000 and I use it towards, we call it a seller payment subsidy program, but basically we take that $20,000 and it offsets your mortgage payment for the first 1, 2, or 3 years, depending on how long you believe that it's going to take mortgage rates to go down. You can see a drastic reduction in that mortgage payment for the first 1, 2, or 3 years. And we just did an analysis the other day where literally they were going to get $150, $140 a month payment by dropping the price, or north of $1,000 a month payment by using that subsidy program to reduce that payment. Now, that's not permanent, Tyler. That's not 30 years of $1,100 savings. It's only for the first 1, 2, or 3 years. But like I said, this isn't a 30-year interest rate problem. I just need to solve for the elevated mortgage rate environment that we're in long enough for inflation to continue going down, because 100% of the time, given a long enough time horizon, mortgage rates follow inflation.
Okay. I like that concept. I have some concerns.
Well, I had a follow-up question too, so maybe you can add on to this. I have a $20,000 concession. You put that towards the first, call it 2 years of payments. Am I still making additional payments too then?
Yes. So the way it works is you're actually buying down the starting interest rate of the mortgage for the first 1, 2, or 3 years. And you can buy down, depending on the amount of the concession you can negotiate from the seller, Chad. You could negotiate 3 years of reduced payments where the interest rate is reduced 3% for year 1, 2% for year 2, and 1% for year 3. So you have kind of like an elevated payment plan over that first 3 years. And if you didn't refinance, then it's going to take you in year 4 up to what your payment would have been based on, let's just say that the rate is 7%, just for hypothetical easy numbers, right? So it's a temporary or stepped up graduated payment over that period of time, but you're using the seller's money to subsidize that. Now, here's the great part, Chad. Let's say in 6 months, mortgage rates go from 7 to 5%. And you're going, now's the time to refinance. We can refinance that indebtedness at any time. We do that for our customers anytime within the first 3 years at no cost. We waive all of our costs to restructure that indebtedness. And any amount that they put in the payment subsidy bucket, that $20,000, any amount we didn't use to subsidize your payment, boom, goes towards reducing the principal balance of the loan that you were in, and therefore reducing the amount of the refinance loan that we refinance.
What are the downsides, Josh? Is it one of those scenarios where no, it actually is that good? I mean, there feels like one of those ones where you're like, well, something has to give a little bit. What can go wrong in this strategy?
Literally the only downside. So from a mortgage underwriting standpoint, we're still qualifying the buyer based on the note rate of, let's say, 7%, right? Which is just a hypothetical note rate, everybody, right? I'm just picking a number. So we're still qualifying their ability to repay based on that. They just simply have the benefit of making the lower payment. In this scenario I just laid out, they would be making a payment at 4% for year 1, 5% in year 2, 6% in year 3. And if you hadn't refinanced in year 4 through the end of the loan, your payment would be based on that 7%. So the only negative that I can come up with, Chad, is that I haven't thought through what those payment raises are going to be as it reflects to an actual impact in my budget. And even though I qualify for it, my cost of living has gone up over the next couple of years. And then I'm going, whoops, I forgot my payment was about to go up $300 a month this year. But besides that, there literally is no downside to that strategy.
Yeah.
To me, that sounds like a version of an adjustable rate mortgage that is definitely going to adjust up.
Yes.
In order for it to, because sometimes we have clients who they can see from a cash flow standpoint and perhaps like a life situation. Like we've had some people who are like, they know they're going to just be in a location for like 5 years. Mm-hmm. And they're like, let's do a 7-year ARM.
Yeah.
And like, okay, like I can get behind that concept because of an event that is going to force them to have to get out of it anyway. But like there is still the risk of like, well, what if things change and you end up not selling and like rates go higher? There's the risk right there. And of course, if interest rates fall, then they're in a better position. It sounds like this strategy has some potential benefits, but it is leaning on that one risk that you identified. And also, like if I were to present this to a client, I'm thinking from like a fiduciary responsibility standpoint.
Yeah.
I would be thinking, I have to tell them, I and no one else can tell you if his interest rates are going to fall or not.
Right. Yep.
Is that accurate to say?
100%. Yeah. I mean, well, we know interest rates go up and down. We don't know the time horizon. So is that in 12 months, 24 months, or 50 months? We don't know, right? But we do know that mortgage rates follow inflation. And we do know that inflation has peaked and seems to be going down. Now, what's the $1 million question here? Maybe $1 trillion question. What happens to tariffs impacts on inflation? And could that cause inflation to spike? And if so, could that cause mortgage rates to spike? Perhaps. So when I'm talking to a client about this, the risk that I'm calling out is you have to be comfortable with year 1 payment, year 2 payment, year 3 payment, and year 4. And if you're comfortable with those graduated payments, great. Like, let me give you a real live example, Tyler. I had a young physician who was coming out of residency, going into their first attending job with student loans, everything else. They were like, I'm basically going to be able to buy a home, but I'm not going to be able to do any other investments for probably the first year or so, at least the first year, because I got to get, So we looked at this seller payment subsidy program, and they were like, whoa, if I can save $1,100 a month for year 1, I could actually start investing something with my financial advisor year 1. Okay, then year 2, your payment's going to go up $300 a month. So maybe I pull back some investments from my financial advisor, or maybe my income goes up. Because most physicians have some sort of annual increase in income, and maybe that increase in income enables them to cover that increase in payment. But you have to be comfortable with all years. Right? You can't go, I can only survive on year 1 payment. Once I get to year 3 payment, I'm screwed. That's right. Not, you don't put that person into this vehicle.
Oh, man.
I was going to say, isn't this the housing crisis conversation all over again? Well, and from a planning perspective, though, that's how I'm thinking of it. Like, hey, in 3 years, here's your payment. Call it $5,000 per month for just easy numbers. Yeah. So when it's lower than that, you still need to be used to $5,000. In my head, I'm thinking it's almost like when you're doing the 30-year versus 15-year number, but invest the difference and then pay off the 15-year type conversation. That's where my head is right now. But also, if you can, if we just we bolt down a lower rate, won't we also get a little bit more bang on our buck too if we are paying more now towards principal? So like, let's just say the payment was supposed to be $5,000 a month, but for the next few years, it's $4,000, maybe $3,500 per month. If you can continue to pay that $5,000 even with the lower number, aren't you also getting a little bit more bang on your buck there with that lower rate?
You are, absolutely, because every additional dollar goes straight to principal. I like that. I mean, personally, I like the idea of them getting on track with their savings, especially if they're not, right? Like the thing that I worry the most about with real estate, or at least buying real estate early, is people seem to have like one track minds, right? Either I'm going to put all my money towards paying off student loans, or I'm going to put all my money towards a home, or I'm going to put all my money towards investing. And you guys are the experts here, but I like, if you can check all three buckets, I think you're better than checking one bucket, right? So this is just becomes a vehicle where you say, does this enable you to pay a little bit more towards your student loans? And does it enable you to save a little bit more year one? Yes. Great. I would call that financial success for the first year, because you're now starting to rebuild that nest egg that you may have depleted through the acquisition and furnishing of this new home.
Mhm.
Yeah.
Yeah, I mean, that trajectory of cost increase does dovetail with a number of real life scenarios I've encountered. I mean, like new attendings, they've got higher costs for, like, some of them have, like, I mean, I do have an issue with recommending a doctor with credit card debt applying for a mortgage. I think they got to get rid of that first. But like private student loans, I guess, like where they've got like $40,000 to pay down, and if they could have an extra $1,000 a month to pay on that for a couple of years, yeah, I can see that being a tool in the belt. That makes sense. Thank you for fielding my questions. I come with scrutiny always, but I mean it with love.
I am more interested in learning than I am being right. So I love the contrast back and forth. And I think the delineating decision for me, and I think for clients should be, are you comfortable with those? It's like an adjustable rate, like you said, except that you know where the caps are and you know exactly what it's going to go to. The problem that was wrong with adjustable rates back in 2008, 2006 was that they had extraordinarily high jumps, right? Like you would go up 5 or 6%, and the caps were very large. So you didn't know in year 5, was your payment going to go up 1% or 6% in year 5? And then, God forbid, you took an interest only or a negative amortizing loan to compound the problems on top of it. So I would say this is safer in that for 30 years, if the worst case scenario happened, it would never go higher than the start rate. You're just getting a graduated payment into that start rate, and then it's locked in.
Cool.
And Josh, this is something that you can do on a physician mortgage, physician loan, or if a conventional mortgage ended up being better, you could also do it on that as well.
So we have multiple physician loan programs and multiple jumbo programs and multiple conventional programs.
Yeah.
It's not ubiquitous across everything, but
Okay.
there are either temporary or permanent buy down solutions on virtually every product, but it's not available on every single product that we have.
Yeah. Okay.
But many times when people are saying like, buying is the right decision for my family because whatever, we've got dogs, we've got kids, the school area, whatever, we're really having a hard time with this payment, then this is something we're going to show that physician and say, okay, would a graduated payment over the next 2 or 3 years help you? And many times they're like, that would be unbelievable. I could have some breathing room for the first year or two.
Okay. Yeah, that's very interesting. I have another burning question.
Go for it.
Sorry, and like I don't mean to dominate. I just I've got a lot on
I
my
love
mind.
your question, so keep going.
Okay. Okay, so as a business owner, I know very well the extraordinary challenges of qualifying for a mortgage under that circumstance, not W-2 income. And I hear so many stories from physicians who, more and more, it's not all the specialties, but I'm thinking like anesthesia and EM, especially, they're relegated to 1099 income. And how do you solve that? How do you solve the problem of the business owner physician?
And we see a lot of people coming into partnerships. So they're going to make a percentage of whatever the partnership makes. So we've seen it all. This is such an incredible question. So let's go back to the inception of why this is challenging. So in 2010, there was a body of law that was enacted called the Dodd-Frank Act. And this is in the wake of the Great Recession. And it was, I believe, created with all good intentions in mind. Unfortunately, sometimes what government does creates unintended consequences. that body of law said that it's actually illegal for a mortgage company to make a loan on an owner-occupied home unless they have proven your ability to repay that mortgage, Tyler. Now, the thinking was good. We don't want Tyler to get into a mortgage that he can't repay, so these predatory banks can come in and foreclose on Tyler, which trust me, no bank wants to own a bunch of real estate. But there was a protection mechanism in mind there. The unintended consequence of that was, how do you prove a newly self-employed borrower's ability to repay? Whether they're 1099, whether they're a percentage of partnership, whether they're starting their own firm, or, I've seen some instances where there's locum tenens income, where there's 27 different forms of income in the last 24 months. So those scenarios get really tricky as it relates to that Dodd-Frank Act. So what we've created is a suite of programs that are specifically created for self-employed entrepreneurs, people in and outside of the medical space, to be fully transparent. These are people that have their own businesses or are partners or 1099. Their tax returns would not prove their ability to repay, but we can document that income in some other way. So here's a couple of different ways. If they have an offer letter or an employment agreement as a partner or as a 1099, oftentimes we can get enough juice out of that documentation to justify the income and qualify as prove the borrower's ability to repay. Other times somebody's self-employed or 1099 and maybe they're only in the business for 12 months. They don't have 2 years tax returns. Well, we can use a cash flow analysis of that business over the preceding 12 months. There's another option where if you have significant assets, like this is one where somebody's been attending for multiple years, they've built up a net worth. Now they've just moved into self-employed land and I don't have 2 years of the tax returns. I can actually use their assets on what's called an asset depletion program as an ability to repay that mortgage. And then we've come out with a program that is truly, it requires a larger down payment, Tyler. You have to put at least 20% down. But there's a truly no income documented program also for physicians that we have, but it requires a 20% down. So bottom line, if you've been turned down or declined by another bank, every bank doesn't have the same guidelines. Give us a shot at trying to help you there.
Okay. The cash flow analysis, does it need to be 12 months at least?
The cash flow analysis does need to be 12 months at least, and it would be personal bank statements or business bank statements to justify that.
Okay. Personally, I think all these timeframes are very reasonable, even from like a business sustainability standpoint. Like that's important. And not to say, of course, physicians also, they tend to have very high job security, but they don't have that job that, they have their job, the self-employed job. I also think that it's beneficial in that unless a doctor is moving to a city and is moving to a job situation that they're really familiar with already, I don't like them buying a home right away anyway. So maybe these are some helpful guardrails to be like, nope, sorry, you got to wait at least 12 months. So I can see the wisdom of that.
The real frustrating thing I find for physicians that I think should be in a position to buy a home right away is we'll have situations where somebody's a W-2 employee inside of a practice. And then after a number of years, they become a partner or they buy the practice or something like that. And they've essentially already been integrated into the practice for a number of years. And they understand the ins and outs of that practice and they know their income's about to go up. Whoops, sorry, you just moved to self-employed, can't do anything for you for almost 3 years, because you think if you're brand new into that, you have to have 2 years worth of tax returns. So, that can be a real bummer and a significant inconvenience. So that's why we came up with these programs, because we can see people have the ability to repay. Let's just figure out how do we document that in a way we can stay in accordance with the law.
Cool. Thank you. That's very helpful.
Great question.
I have more questions, but Chad, do you want a shot?
Yeah, let's go back to 101. Josh, in your best description, tell us what a physician mortgage is.
Great question. So a physician home loan is a loan that enables a physician to buy a home with either better terms or sooner than they might be able to qualify with a conventional mortgage. Better terms usually looks like low to zero down payment, higher loan amounts, so you can get into the jumbo lending world, which typically requires 20% down, enables you to close on a future income like an employment contract rather than having paycheck stubs in hand. I mean, imagine the situation of, and it's certainly not the right decision for every resident physician to buy a home, but in Ohio, for example, you can buy a home for 190,000. Not a bad idea to look and see if it makes sense if you've got a long enough residency program to see what that looks like. And if you look at if you look at that resident's income information, they've been going through medical school and they have a bunch of student loans. So how in the world would they qualify? So a physician loan can come in helpful then. Again, it's not the right decision for every resident. Many residents should just rent, but sometimes they have kids. Sometimes they have, they can't find a suitable rental place to live. So better terms can qualify for that mortgage faster. And then just to go back to Tyler's previous question, if you've gone into self-employed in the last couple of years, conventional loans can't help you at all. Jumbo loans can't help you at all. You need some sort of specialty program like this to get into a home.
What are the down payments for Neo? For like you said, if you're in Ohio, maybe not an issue, but if you're in the Floridas, the Northeast of the world, Southern California, a fixer-upper with maybe a meth lab beside you is still $1 million in some of these neighborhoods. Like, what are the down payment requirements on Neo? Because that's one that I catch. That comes up more often than I would think, right? Where people are like, "Hey, I'm looking for $750,000 home, but I don't have to put anything down." I'm like, well, there's usually still like 5-10%, but what are the requirements for Neo?
100% financing to $1 million and 95% financing to $1.5 million. So, you can get a significant home. And where I feel it makes a lot of sense to look at those lower down is when physicians don't have a lot of excess liquidity elsewhere. Like maybe they could do 5 or 10% down, but that's going to put them in a situation where they're either cashing out other investments or they're depleting all their liquidity. And now they're going into a new home purchase with no liquidity outside of the home. And I think that's a dangerous situation personally. I think you need to have some living expenses sitting there because air conditioning units go out and roofs go bad. And there has to be some sort of forethought and planning around that.
Yeah, we say it was much easier when rates were at 3%, when saying, hey, if you don't get anything down, I'm not as worried about it. Now when they're, 7-ish, like, hey, I know it says you don't have to put anything down, but let's try to get something down if we can. I'm not even, let alone the pricing discrepancies in some markets too. So totally agree.
And I should just say to that, Chad, if even if they're willing to put a down payment on a physician loan program that enables them to do zero down, they'll get a better interest rate too. So it's definitely worth looking at. Hey, what does 5, 10, 15% look down, 20% down look like? And then you can make the right decision based on their overall financial situation.
This is just a fun side question, but how often do you see fake physician mortgages?
What is a fake physician mortgage?
Yeah, I'm curious.
So I always say it's at someone that's marketing, and I'll give you my best example that to this day is my favorite example. But essentially, they're saying that they offer physician mortgages, but it's not a physician mortgage. So we had a new client join us a few years ago, and they came to us and they had 2 mortgages, and you can probably guess the numbers on their mortgages. One was 80%, one was 20%. And they're like, oh, it's a physician mortgage. Look, I don't have PMI. I'm like, no, you don't have PMI, but you have 2 mortgages. You have 2 forms of debt now, and that's why you don't have PMI. They're like, no, they definitely told me it's a physician mortgage. I'm like, this is not, I don't know what this is, but it's not a physician mortgage. And I've seen other ones suspicious. That one was the most like blatant. But now that I had to give you that whole story, maybe it's not as common as I thought. But are there weird stories of like people that pitch physician mortgages, but they don't end up being what I would label as a traditional physician mortgage?
What we see the most, Chad, is where somebody starts down the path with a lender and they're like, oh yeah, your employment contract, no problem. We can close on that. Oh yeah, all your student loans that have 0 payments, of course we don't have to hit you with that. and then they get a week from closing and the whole thing blows up. And then they come to us and they're like, I got a week to close. My loan was just declined. And you asked them the situation and you're like, clearly you were not on the track with the physician loan because, or your mortgage originator just had no clue what they were doing. So that's where we see that on my end is when they blow up and then they come to us, with a week to close. So, I would say we see those on a monthly basis.
Good.
Somebody blows something up and they end up in our lap, and we're grateful to have the opportunity to try and solve it for them.
Josh, I got another question for you. Obviously, you take pride in the firm that you've built and you try to do like good by the people that come to trust you. So you know internally that you're one of the good ones. How can a given physician, how can they vet you?
Such a great question. So I'm a review guy, right? Like I pick my restaurants on reviews, I pick my hotels on reviews, and I would be looking for reviews. I know if you go to our Google review page, our physician home loan page, there's 500 plus 5-star reviews on there, and I think we're like 4.87 over all the people who have reviewed us or something like that. So I always say you should ask for reviews. If your person doesn't have a review platform, you should ask for referrals, like other physicians in your city that worked with that lender that successfully navigated the home market and did a good job for that physician. The other thing, I guess, is if you're already working with a local realtor, Tyler, these communities are small. The communities of realtors that tend to work with physicians and the community of lenders that tend to work with physicians, they tend to know each other. So you might want to ask your real estate professional if you have a good trusting relationship with them as well.
Yeah, that was the route we went with when we bought a home here in Connecticut. Our realtor was a referral from a friend, and then our mortgage banker was a referral of hers. And it went really smoothly, really communicative. I found like there's so much detail of your job that I have no idea about, and I wouldn't know how, like on the outside, how to discern a distinction between someone that's doing a good job and someone that's doing a bad job until I'm in it. You're like in the midst of it and like someone's not responsive or like they're changing their requirements. I mean, that fortunately hasn't happened to me, but I mean, based on what you're telling me that has happened to other people that have come to you later on, all of a sudden having the rug pulled out from under you, those obviously are bad things. So I can appreciate the review concept.
Yeah. And, it happens more frequently than you would think. I think a lot of physicians are familiar with their financial situation and they're like, hey, I'm creditworthy. So how could I have any problem getting a home loan? And then there's something in the employment contract, or there's something about the way the down payment funds moved, or there's something funky about the property. And they run into something blowing up mid-transaction. That's the whole reason I wrote a book 8 years ago titled "Why Physician Home Loans Fail: How to Escape the Landmines." And it was because we were getting a ton of people coming to us with blown up transactions, 1 week to close. And I can say that trend has actually decreased over the last decade. That period of time was very difficult to obtain mortgage financing because it was in the wake of the Great Recession. But we still see multiple deals per month where they are declined somewhere else and come to us. In fact, we have a great testimonial. I'll share it with you guys. This was a self-employed doctor. I can't remember exactly what his specialty was off the top of my head. He'd been declined by 10 different lenders, 10, and eventually made his way to us, and we were able to get his loan closed, I think in like 11 days. It's a crazy testimonial video. But that's just an example of someone who started with someone who clearly was not in the physician lending space. They told him, you're good, go write an offer. Then once he declined him, he had to go through a bunch of other legitimate physician lenders that couldn't get the deal done because of this obstacle, but it was the obstacle that the first lender missed that got him into this trouble. So I'll just share that video with you because I think it's really my passion. That there's nothing more fun than a physician calling us and saying, we just got declined by another bank. We're supposed to close a loan in 3 weeks. And when we get to solve that, like that's hero stuff for us. Like we get so excited about that kind of stuff.
That's awesome. Yeah.
Josh, what because I know like when we've contacted you before, like it feels like there's like a Neo team in like almost every state. Do you cover all 50 states?
Yeah, 49 states. So everywhere but New York.
No one wants to deal in New York anymore. It's funny.
I mean, I think we'll be there by 2030. So maybe have me back on a podcast.
Yeah. We'll bring you back.
Yeah, they're a difficult state. So our physician-focused team is out of Salt Lake City, Utah.
Yeah.
So all of us are housed out of a central office here, but we lend across 49 states.
I've seen the videos and spreadsheets that you send individuals to kind of show their options. But how important is it for, and I try to always describe it this way at presentations or to prospective clients, but I think sometimes physicians hear physician mortgage loan, physician loan, and they're like, oh, it has my name on it. It must be for me. But how important is it for them to also compare to a conventional mortgage? And even though like PMI sounds like the boogeyman, for some people, if maybe there's a lower rate, that still may make sense even with lower than 20%. When you all are walking through with clients, that's something that you build into your analysis too for them, right?
Yeah. So what you're alluding to is what we call a total cost analysis. And it's basically a personal financial website that we create for every client. And it goes through and shows them all of their different options. So here's what it might look like on a conventional loan. Here's what it might look like for an FHA loan. Let's say that the physician is a veteran. Here's what it looks like on a VA loan. And then here's what it looks like on a physician home loan. And what most fee worksheets show you is what's the rate and what's the cost. But that makes it difficult when you're looking at 4 different sheets to understand what is the total cost over the time horizon you plan to be in the home or in that loan. So what we try to show them is these different, what we call strategies, and the amount of cost over the specified period they plan to be in the home or loan, and the specified amount of equity that they would gain over that period of time. Because different interest rates have different amortization charts associated with them. So to your point, Chad, you could have a scenario where you have a lower rate with PMI, and let's just say that the payment is the same as the physician loan with a higher rate, but you actually end up more wealthy by year 5 because the lower interest rate necessitates a greater amortization, and you're paying more towards principal every month. So we want to chart all of those things out, not only the rate, the cost, but over the time horizon and how much equity you're going to build with each option. That also allows us to compare, okay, we're good. We want to go with this physician product. Great. Now let's talk about the different buy down strategies, because the area that you're buying in has slack in the market, and we can see that you're going to be able to negotiate a discount. Where should we put that money? Should we, reduce the price? Should we use it as a concession? Should we permanently or temporary buy down the rate? So it helps us to really narrow down and pick the right strategy for the physician.
I like that.
Yeah, that's great detail. I think that's the kind of approach that I think I can speak for Chad that we both try to take with just overall financial planning. It's about being able to pull accurate data and then process it and then present it in a way that is digestible and they can see, so that they can make an educated decision. That's great to hear.
Yeah, and when you're taking out $1 million in debt or $500,000 in debt, like I think this necessitates a pause, and it's worthy of some contemplation of the different strategies and which one makes the most amount of sense. And then hopefully through that process, it brings around confidence, because when people feel confident and they have all the information, then they feel inspired and confident to make that decision about the house. We see oftentimes where when you've done all that due diligence and you've landed on a strategy and now the right house comes, you're ready to move very, very quickly. Conversely, if you haven't done that due diligence and you haven't thought through the strategies and now you're trying to figure it out when the house hits the market, you may lose that house to a competing offer. So we try to get all that work done and what we call pre-underwriting done before you go find a house, so that when you find a house, we can move as quick as somebody closing on a cash transaction, usually within a couple of weeks, to get the deal closed for.
Which in today's competitive market is very important.
Yeah, and like I said, real estate's local. So there's markets that have slack, and there are markets that have no slack. That there's multiple offer situation. We were just talking with a physician, the client the other day that's buying a house in Santa Barbara, and there's like 3 houses for sale that fit his description. So he has to be, ready to move and be able to move as fast as cash because we know there's going to be multiple offers and when that house finally hits. And there's homes coming to market, they're just gone like immediately. So how do we stack the deck, so to speak, in the physician's interest so that when that house comes, boom, they know the strategy, they know all the numbers. Let's write an offer and oh yeah, we can close in 2 weeks. We don't need 30 or 45 days. So that's another thing on the other side of the spectrum. If there's not inventory and you've got to move quick, that's another way that we can help those physicians get the house they really want.
I also might add something that helps, and it helped in our case because we were in that market a couple of years ago, is we wrote a letter and sent it with a really nice picture of the 3 of us.
It's crazy, but you know what? We're husbands, we're fathers, we have family. I think about my kids and the memories they had in my home, and I would hope your kids are going to have similar memories, right? Like that connection means something.
They like to know that a family's buying and not BlackRock, so it always makes them feel better.
Yes, exactly right.
Yeah, amen.
Exactly
Amen.
right.
Well, this has been really great talking, Josh. We really appreciate your candor and willingness to to chat openly about all this. I know Chad has, and I have too. I haven't told you this, but we've had good feedback from clients of ours that have gone through your firm, and so we appreciate what you're doing. How can people find you?
Thanks for the kind words, first of all. The easiest way is just to email me, josh@joshmettle.com. You can also, go to our websites, which I can, give you our physician websites. But really, email, I think, to be perfectly honest with you, is the best way to get a hold of me. And let me just add one more thing, especially if you're relocating across the country and you're not familiar with the real estate environment in that state or in that county or in that city. We have a service that we subscribe to that creates what's called a neighborhood report card. It breaks down the number of renters versus buyers in the area, the number of homes coming to market, the amount of inventory, historical and anticipated appreciation rates. And it enables you to really understand at a micro level, like right down to the zip code and to the price. Like you dial it in to find a $2 million house or a $200,000 house. Those things appreciate at very different appreciation rates. So we can dial it down to micro markets into the price range you're buying in. And we can create these for any of your listeners for free. So they can just email me, josh@joshmettle.com. Just put in the subject line, neighborhood report. Let me know where you're potentially moving to. We're happy to create those. But I've found that report is incredibly insightful for people who are moving to a new neighborhood, a new area. And it's a little scary. Like, I think this is the right part of town. It's by the hospital, but I don't know how this real estate asset's going to perform. And I think this can give you great insights.
That sounds cool. I might email you, Josh.
Yeah.
Just get my own neighborhood.
I'd absolutely love to send it to you. So just give me your zip code or your home address and I'll send one over for you.
Okay. All right. Cool.
I was thinking the same thing. I'm going to get the Tampa market now, so I'm sending it.
Yeah. Yeah.
Do it.
All right, Josh. Well, thanks again for coming. Do you have any parting words?
Well, I just respect a lot what you guys do and the approach that you take. And thank you for having me here today. The only other thing that we didn't mention was, we talked a lot about the purchase transactions, but I do believe we're going to see rates drop over the next 12 to 24 months. And I think that if you've bought a home since 2022 at elevated rates, you should be watching that. We set what's called a strike rate tracker for all of our clients so that we're monitoring their interest rates relative to the interest rates in the market. And whenever there's enough of a differential there to make sense to restructure that indebtedness, we just reach out to them proactively. Like I said, we'll refinance that loan anytime within the first 3 years for free. But in closing, if you have refinanced at those higher rates and you want us to track your rate relative to the market, we're happy to do that for you. But I think you should be watching that. I think there's a fairly decent probability we'll see rates come down in the near future.
All right. Leaving us salivating at the end. I like it.
Exactly. Like I just keep everything in a note, and I have to go check to see which clients are getting close to the deadline. I got to add some cool tech to that.
There you go. All right, Josh. Well, hope you have a good day. Chad, it was good to see you.
Yes, as always. Thanks, Josh. We appreciate it.
Thanks, gentlemen. My pleasure. Thanks for having me.
This information is for general purposes only. This information is not intended to be a substitute for specific professional financial or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Deals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state-registered investment advisor.